Hey everybody, Chuck Barone. Wednesday, August the 2nd, 2023. We're closing out the end of this third quarter. Let's see what happens here in August. It's going to be an interesting month if it's starting out like this, right? But before we get rolling, let me welcome everybody to the show. Thank you guys for your support. You guys showing up every day watching our videos keeps us going here. We appreciate you guys and hanging with us. All right, so let's look at this markets today. Well, we know that we got big news yesterday. Actually, the news came after the market closed, with the ratings agency Fitch downgrading U.S. creditworthiness on U.S. debt. Not a good thing for the U.S. here. Very embarrassing. I don't think there's any concern anywhere about the U.S. not paying its debt. This is more a criticism of our political dysfunction than anything else, I think. But nonetheless, that downgrade spooked markets today, gave people a reason to take profits. As a result, the stock market today has its worst day since February of this year. The Dow leading the way, down 348 points, resting at 35,282. The S&P dropped 63 points at 4,513. The NASDAQ drops 310 points, 13,973. Horrible day for stocks. The market had been really rolling, but this downgrade spooking everybody. And like I said, people have big profits in these markets. If you look at some of the results we're at this year so far, you have the S&P right now, as of today, up 19%. The NASDAQ up 36% so far this year. So a good reason to take profits. You get spooked like this. Earnings today, Chevron and a couple other companies coming in, not so great. And further dragging the market. So here we sit. Bond market today, kind of another weird day in the bond market with mixed results. The 10-year yield continuing to rise, up 3 basis points, sitting at 4.08%. The 2-year continuing to fall, down 3 basis points, sitting at 4.88%. So now you can see this yield curve starting to narrow. I don't think yet this is the yield curve going to straighten itself out, but interesting to see that yield curve narrowing and 10-year rates climbing. That's going to be a big pain for the U.S. government because getting more expensive to service this however many trillions of dollars in debt we got, we're rolling over. Weird bond market, man. Has been for over a year now. The dollar today up again, up still 102.65 on the index. The dollar very strong. Not a lot of real new news there. Surprising the dollar up with Fitch is coming out and downgrading like that. But nonetheless, here we are. As a result of that strong dollar, metals further sinking. Gold down $9.50 today at $1,934.50 per ounce. Silver down 61 cents today, $23.65, moving further and further into the negative now, away from those targets of 2,000 gold, 25 silver. I still think metal and gold and silver want to run. But in the face of that strong dollar, it is what it is. I think that when the dollar starts to come back down to earth, which it will, gold and silver are going to fly again. Watch and see. Oil today, again, down small today, but down $1.63 per barrel. Now sitting at $79.74, down almost $2 in a couple days. Now, let's see where it goes. It's going to be interesting because, as we've been following gold on the show here, we've noticed that it really seems to be the most comfortable trading between 70 and 75. That's the trough. It has these breakouts like this occasionally, but seems to fall right back into that trough. We're following oil here, and as we can see, it was just up over $84 or $80 and $81 and change just a day or two ago. Now coming back down to earth. I don't think it'll be long before we see it right back in that 70 to 75 range. Bitcoin today, down small, down $58.81, 29,133 for Bitcoin, still holding its own. All right, so let's talk about news today. Let's talk about this Fitch downgrade. A very unfortunate thing because we were getting a lot of pretty good economic news. You know, the Fed's having its way, inflation numbers coming down, economy staying strong, job market staying strong, earnings for the most part still strong, consumers actually making more money, still spending it like it's going out of style. So, you know, everything looking kind of good for the U.S., all things considered. And then comes this Fitch downgrade, and boom, everything changes. So here we sit now. They cited, this is great, they said that Fitch said the U.S. economy is likely to deteriorate over the next 3 years. The country has a massive national debt and has shown repeated political gamesmanship over managing the country's finances. Now again, I really don't believe anybody believes the U.S. is going to default on its debt, because it's just not going to. This is more a critique of the political picture in this country, how the politicians seem to have no regard for some of the consequences of what they do or don't do. This debt ceiling thing that they've been doing repeatedly, and both parties are to blame for this one. It's just sad, because this is something that did not need to happen. They said they had concerns about the erosion of governance in the U.S. relative to other AAA-rated peers, specifically with respect to difficulties raising the debt ceiling, oscillations in tax policy, and big increases in government spending. So this is all stuff that is true, right? We know that we have seen what both sides of the political aisle have done with this debt ceiling, seeing it as an opportunity to have their way on a couple of political issues. I guess it's political tactics these days. Nonetheless, while we might think it's awesome and fun and cool, the rest of the world does not. We also have pretty significant oscillations in tax policy, as both parties are, they have their differences on taxes, but both parties really, neither party proposing anything close to having taxes that are even close to paying what they're spending. Nobody's talking about that. And then you have big increases in government spending, which we've seen when COVID hit, the government just printing up trillions of dollars and sending it out to people. Continuing now with Biden and his administration, believing that they can spend any amount of money they want and have no real repercussions for it. It's just another number added onto the deficit in the national debt. Well, it looks like the piper is, paying the piper, the time is coming due for that now. It's going to be interesting. Fitch is the third wheel in the ratings agencies with Standard & Poor's and Moody's. We know all three of these groups, companies, whatever, got bloodied up pretty bad in 2008 and 9 when they were easily giving AAA ratings to really garbage mortgage paper, helping companies sell that paper on the open market as AAA rated paper. Kind of an underhanded scam where poor investors got to eat these bonds, while the banks and the ratings agencies got to make Brazilians of dollars packaging, rating, and selling those bonds. Now let's see, what's going to be interesting here is to see if S&P and Moody's follow suit on this downgrade. I think that if all three rating agencies were to downgrade the U.S. debt, even though it's AA plus, not AAA anymore, it's still a pretty solid rating, obviously. But I think that would be a pretty bad signal for the world. But maybe, who knows? I mean, is it possible that something like this could serve as a wake-up call to some of these knuckleheads in Washington who just, they're so consumed with their own bullshit and their own political, whatever they want to call it. The fighting and the beating up on the other team and owning the libs and owning the right, and the silliness, man, where it's not about governance, it's about raising money and getting raising money and riling up the base, and they both do that proficiently. Hopefully, though, this serves as some kind of wake-up call to these guys that maybe buckling down and getting on to governing the country might be a better thing for them in the long run, and a better thing for the country, certainly, than this political gamesmanship that we see pretty much on a daily basis. Moving on. Atlanta Fed GDP Now tracker. I had to take a peek at that today, showing 3.9% growth so far for the third quarter 2023. So we had 2% growth in the first, revised 2.4% growth, revised down to 2.4% growth in the second, now estimating 3.9% growth in the third. I'm sure that number will come down a little bit, revised down or whatever. But these are solid economic numbers for this country. Presidents, at least the realistic ones, typically set a target for an economic growth in our country around 3%. I think that, these numbers, everybody's going to be flaming me on this again today. Please don't, okay? I understand that, most of you guys have serious doubts about the numbers the government reports, but these are the numbers that we have. So these are the numbers we have to base our calls on and report on, right? So nonetheless, the economy in the U.S., despite everything, despite high interest rates, despite high inflation, despite political dysfunction, despite the stupidest pack of friggin' politicians ever put in power in this country before, despite the lingering effects from the COVID, despite the sour, negative mood in this country, despite people racking up record levels of debt, the U.S. economy keeps on chugging along, man. Keeps on chugging along. So now, this soft landing scenario that everybody's been talking about since last year now starts to come into clearer focus. Now I was just saying yesterday, I got to see this to believe it. Because most times, well, you've heard me on the show many, many times compare a soft landing to the Hindenburg landing, right? So we'll see if they can actually pull this off. I was waiting for there's always that surprise, and today starts the surprise with Fitch. We'll see how Standard & Poor's and Moody's follow suit. So a lot of conflicting information, and despite it all, the U.S. economy just keeps on going. So that's it for the day, guys. Tomorrow, we know we have a very big day tomorrow. Lots of big data coming. We're going to get factory orders. We're going to get jobless claims. We're going to get productivity numbers. We're going to get unit labor costs, which are important. We're going to see if labor costs are continuing to rise. So tomorrow is going to be a massive day for data. We'll see how the market reacts, and if there's any other wild cards like this Fitch move here to jostle these markets. Fascinating times, guys. Big finish coming this week. We know we're going to get a big jobs number coming on Friday, too. How many jobs were created in July? I can't wait to see that number. They're estimating 200,000. They've been off before, usually to the low side. We'll see how many jobs the U.S. economy created in July coming up on Friday. So we got a lot of reasons to be here to bring you guys news you need. A lot of reasons for you guys to be here listening to this, watching this show. Trying to bring you guys the news you need to set yourselves up, to be prepared for what's coming in this economy and your portfolios. Here it is, guys. Anyway, that's it for the day. Really appreciate your support, guys. Can't tell you how much it means to us. If you can, after you watch this video, please hit the like button. It changes the algorithms at YouTube, gets our video in front of more people's faces so more people can watch it. Would appreciate that. As always, hit me up in the comments with your questions, anything at all. And we'll be back tomorrow to bring you guys the news you need. Until then, guys, take care. Thanks.